In 1986, tankers carrying South African oil didn't exist on paper, yet they kept docking, refueling, moving. How? Because when a nation is cut off from the world's arteries, it starts growing new veins, invisible ones. Sanctions were supposed to choke the apartheid regime. Instead, they built a second economy, quieter, darker, but astonishingly efficient. Western companies sold parts through front offices in Zurich. Gold moved through Dubai long before Dubai became a headline. And while politicians spoke of morality, traders spoke of margins. Both were right in their own language. The world called it isolation. Economists later called it adaptation. South Africa called it survival. And now, 4 decades later, the pattern returns. Not in Johannesburg, but in Moscow. Different ideology, same physics. When the formal market closes, the shadow market begins to breathe. Every embargo is an equation. Inputs, resources, need, and fear of scarcity. Output, creativity, corruption, and resilience. The stronger the wall, the faster the tunnels appear. That's not politics, it's economics under pressure. Back then, oil had to move. Gold had to find buyers. The rand needed dollars. Each restriction redirected value, like a river finding new channels after a dam. What couldn't be traded openly found new names, new currencies, new friends. Some of them never went away. What's fascinating is not the morality, but the mechanics. Sanctions are supposed to break systems. Instead, they often reveal how unbreakable systems truly are, if profit remains at stake. Today's Russia faces hundreds of restrictions, thousands of banned goods, millions of improvised routes. The map looks sealed, the flow is not. Parallel markets grow in silence until they become large enough to be called normal. The paradox is simple. Isolation multiplies connection. To understand how a state survives isolation, we need to return to the structure of global trade in the 1970s and 1980s, the age of fixed alliances, paper money, and geopolitical walls that leaked like sieves. South Africa was not simply a country under sanctions. It was a laboratory of economic improvisation. The apartheid regime, officially condemned by most of the world, stood on 3 pillars: minerals, energy, and finance. Gold, platinum, and diamonds fed the global jewelry and electronics markets. Coal and uranium powered industry. And the South African Reserve Bank held one of the largest gold reserves outside the great powers. In theory, cutting this system off should have been simple: embargoes on oil, trade restrictions, cultural boycotts. In practice, it was impossible, because the world needed what South Africa had, and South Africa needed what the world produced. That contradiction birthed one of the most complex networks of parallel exchange ever seen in the 20th century. In 1973, the Arab oil embargo hit global energy prices hard. South Africa, already excluded from OPEC and shunned by most producers, faced an existential crisis. Without oil, its mines would stop, its economy would collapse, its army would stall. Yet the lights never went out. Tankers kept arriving, routes shifted through the Persian Gulf, Singapore, and the Caribbean. Crude oil appeared on paper as lubricants, chemicals, food additives. Each invoice a disguise, each transaction a small act of defiance against global order. Behind it stood banks in Switzerland, traders in Hong Kong, and front companies in the Cayman Islands. They were not ideologues. They were intermediaries in a new economic ecosystem, one where legality became a matter of geography. What was forbidden in London was permitted in Mauritius. What was condemned in Washington was ignored in Panama. By the mid-1980s, the South African economy had split in 2. The official visible layer, tightly controlled, heavily monitored, and slowly suffocating, and the hidden one, flexible, creative, decentralized. One operated on policy, the other on trust. Both worked in tandem, like 2 lungs breathing opposite air. Some historians argue that this duality delayed the fall of apartheid by nearly a decade, because the state, though politically cornered, remained financially alive. Its gold sales continued through middlemen. Its imports flowed through third countries. The sanctions regime punished the surface, not the structure. And yet, that same structure taught the world something new. It showed that markets don't vanish under pressure, they mutate. A sanction system becomes not weaker, but more complex. It stops being transparent, but it keeps functioning. In many ways, it becomes more efficient, because inefficiency now means exposure. Fast forward 40 years. The pattern is visible again, now cast in digital light. Russia, after 2022, stands in the same global theater, with different actors but identical scripts. Oil seeks channels, currency seeks conversion, goods cross borders dressed under new names. The architecture is modern, but the DNA is old. The logic of substitution and rerouting is timeless. When legitimacy becomes expensive, informality becomes a skill. And as before, the world watches, debates morality, while the markets quietly calculate risk and reward. That's how the invisible half of globalization is born, not in meetings or treaties, but in the gaps between them. By the mid-1980s, the system cracked, not from outside pressure, but from its own contradictions. Sanctions multiplied faster than substitutes could appear. Oil prices rose, debt ballooned. The illusion of autonomy began to tremble. Pretoria's official balance sheet still looked solid. Gold exports quietly filled state reserves. But inside, liquidity was evaporating. The rand collapsed from 1.2 to nearly 2.4 per US dollar within a few months. Inflation reached double digits. Investors withdrew, fearing that one more political explosion would make their assets untouchable. And then it happened. The banks stopped lending. In August 1985, Chase Manhattan and Citibank refused to roll over short-term credit lines to the South African government. That decision, made in polished boardrooms thousands of kilometers away, froze the country's financial bloodstream overnight. International markets, once elastic, now tightened like a noose. Trade finance dried up. Cargoes stalled at ports. The country declared a debt standstill, effectively a polite default. That was the moment when South Africa realized something fundamental. Isolation had been survivable as long as money could move invisibly. But the invisible had limits. The same banks that had helped conceal transactions through offshore channels now turned cautious. The sanctions regime reached critical mass, no longer moral theater, but a structural blockade. The global financial system closed its doors. To compensate, Pretoria expanded its internal substitute mechanisms. The Reserve Bank launched Financial Rand, a dual currency system separating local capital from foreign investors' money. One rand for domestic trade, another, heavily discounted, for cross-border operations. It was an act of financial triage, keeping capital inside while pretending mobility still existed. Yet every workaround deepened distortion. Parallel exchange rates created speculation. Importers hoarded goods as hedges against currency collapse. Gold sales spiked, but so did smuggling. A ton of bullion could vanish in one jurisdiction and reappear in another, unchanged in weight, different in identity. Behind these numbers was a psychological shift. The idea that law and economy were separate began to dissolve. The market had learned to operate without legitimacy. And once that happens, legitimacy itself loses value. Some analysts describe 1985 as South Africa's monetary blackout. Others see it as the moment when the country crossed from a regulated economy to a networked one, where intermediaries, not institutions, defined reality. Every shortage became an opportunity. Every prohibition became a price. And that's the paradox. Sanctions, designed to isolate, forced integration, not with the legal world, but with its shadow. By 1987, hundreds of front companies operated between South Africa, Europe, and Asia. They handled trade in oil, metals, and industrial machinery under false labels. Tracking them became impossible. The state's dependence on secrecy became total. Now, imagine a modern mirror. In 2024, Russia faces over 18,000 distinct restrictions across trade, finance, and technology. The mechanisms are digital, but the physics is identical. As official supply lines break, unofficial ones bloom. A turbine becomes industrial equipment. A chip becomes consumer electronics. The flow persists, just harder to see. What this reveals is not defiance, but adaptability. Systems, like organisms, evolve under stress. Cut one artery, another grows. The 1985 financial crisis in South Africa didn't end trade. It changed its anatomy. The same transformation now unfolds across Eurasia. So the true problem wasn't the embargo itself. It was belief, the belief that legality could control necessity. Once necessity wins, the market stops asking for permission. And that, more than any decree or speech, defines the beginning of a parallel world economy. Let's strip away the morality and watch the machinery work. Because beneath the speeches and sanctions, what actually kept apartheid South Africa alive was a network, decentralized, precise, almost biological in its logic. First, commodities. Gold was the country's bloodstream. Each ounce could cross borders silently, immune to embargoes, accepted everywhere. When trade and currency froze, South Africa turned its gold into a medium of barter. Oil, spare parts, and weapons all could be bought as long as gold moved the other way. Bars were flown to Switzerland, melted, recast, and resold with clean paperwork. The same metal changed names 3 times before reaching the final buyer. Traceability disappeared, but value remained intact. Second, routing. Nothing moved directly. Tankers changed flags mid-journey. Ship logs were rewritten. Invoices listed neutral intermediaries, Singapore, Liberia, Malta. A barrel of Saudi oil became non-OPEC origin. The physical route lengthened, but the economic route shortened. The distance between supplier and buyer compressed into trust, a fragile, profitable trust built on secrecy. Third, finance. While banks publicly adhered to sanctions, their subsidiaries didn't. Offshore centers like Nassau, Luxembourg, and the Channel Islands became operational shadows of London and New York. They issued letters of credit to front companies that technically weren't trading with Pretoria, yet all invoices ended up in South African hands. The structure was circular. Funds left South Africa disguised as investment, returned disguised as revenue. It wasn't fraud. It was adaptation written in legal fine print. Fourth, substitution. Cut off from suppliers, South Africa built an industrial autarky under the state conglomerate Arms Corps. Technology embargoes triggered local innovation. Synthetic fuels from coal, domestic aircraft parts, even computer components, all born from constraint. Scarcity turned into a catalyst. Every ban generated an alternative. Each limitation created competence. This is how the invisible economy becomes self-sustaining. Trade turns into networks. Networks turn into culture. And culture turns into immunity. By the late 1980s, the apartheid economy had become both sanctioned and globalized. Its operators spoke multiple currencies, understood risk like language, and saw regulation as an obstacle course to be mastered, not obeyed. That mindset, learned in secrecy, didn't vanish after 1994. It migrated into post-apartheid business, shaping South Africa's corporate DNA for decades. Now, translate that system into the 21st century. Replace telexes with encrypted messengers. Replace gold bars with stablecoins. Replace offshore brokers with decentralized exchanges. The mechanism remains identical. Bypass through complexity. When official trade collapses, unofficial logistics arise, not as crime, but as infrastructure. Parallel markets are not shadows of the real economy. They are its mirror, showing how flexible necessity can be. And perhaps that's the true insight. Sanctions are not blockades. They are filters. They don't stop flows, they refine them. The more pressure applied, the purer and more concentrated the flows become. That's why history keeps returning to this pattern, because in every attempt to isolate, humanity rediscovers how deeply it's connected. By the end of the 1980s, the hidden architecture of South Africa's economy was no longer a secret. It was an open riddle. Everyone knew it existed, no one could map it fully. And when the political tide finally turned, the cost of that parallel system became visible, like the imprint of a vanished machine left on metal. Officially, the country survived the sanctions. Unofficially, it paid with distortion. Prices no longer reflected production costs. They reflected risk, transport distance, and bribe margins. A ton of imported machinery might cost 3 times more than in Europe. Every transaction carried a premium of secrecy. Efficiency decayed quietly, masked by high gold revenues. When apartheid began to crumble, those revenues couldn't cover the debt. The dual currency collapsed. The financial rand was abandoned. Inflation spiked. Factories dependent on imported components shut down. The self-sufficient miracle proved fragile, an ecosystem held together by improvisation, not structure. The deeper cost was institutional. The border between legality and illegality had blurred beyond repair. A generation of businessmen, bankers, and bureaucrats had learned to operate in shadows. They were rewarded not for transparency, but for discretion. The very skills that kept the country alive under sanctions became liabilities in an open market. When the new democratic government took power in 1994, it inherited not just inequality, but opacity. Networks built to smuggle oil now smuggled cash. Companies trained in hiding invoices now hid profits. The state had to rebuild not only infrastructure, but trust, a rarer and slower commodity. This is the unspoken consequence of parallel markets. Once secrecy becomes habit, it resists extinction. Informality seeps into everything. Contracts lose meaning. Regulation becomes negotiation. What was born as survival becomes culture. And this pattern repeats, almost rhythmically. Iran after 2012, Venezuela after 2018, Russia after 2022. The sanctioned state always discovers that its shadow economy is stronger than its official one, and then spends decades trying to tame it. The economic scars are measurable. South Africa's GDP contracted by nearly 4% during the height of sanctions. But the hidden cost, the moral depreciation of legality, never entered any ledger. It's not easily reversed. When you teach an economy to function without permission, permission loses authority. Yet there was another, quieter outcome. Adaptation bred resilience. The same logistical ingenuity that once bypassed sanctions later powered South African multinationals like Sasol and Anglo Gold. The skills learned in crisis became exportable. The gray market graduated into globalization. This dual legacy, corruption and competence, is the paradox every sanctioned nation inherits. It gains flexibility, but loses trust. It learns to survive, but forgets how to comply. And when the walls finally fall, the ghosts of the parallel market remain, whispering that rules are optional and that secrecy still pays. In that sense, the sanctions worked, but not in the way intended. They broke the visible economy, not the invisible one. They punished institutions, but rewarded networks. And those networks didn't disappear with political reform. They adapted, quietly waiting for the next blockade, the next opportunity. That is why, when we look at modern Russia, we are not watching a unique story. We are watching a sequel written in another language, with the same ending waiting behind different headlines. History does not forgive hidden systems. It simply lets them mature. In 2024, Moscow is not Pretoria. The slogans are different, the technology is unrecognizable, the world far more connected. And yet, the pattern fits like an old template on a new map. When Western sanctions hit Russia after February 2022, they targeted what appeared to be pressure points: oil, banking, technology, logistics. But the reality, as always, proved more fluid. Every closed port opened a warehouse. Every frozen account unlocked a new intermediary. The visible system stopped breathing. The hidden one inhaled. Let's start with energy. Officially, Russian oil exports collapsed under the price cap regime. In practice, volumes returned to pre-war levels within a year. They simply took a longer route. The Ghost Fleet, over 500 tankers sailing under obscure flags, insured by obscure firms, became the 21st century version of apartheid's invisible oil line. Cargoes switched identities mid-sea. Manifests rewrote themselves. The product was the same, only the paperwork changed. Then came finance. Swift disconnections were supposed to isolate Moscow from the global banking system. But in the age of instant messaging, isolation is relative. Rubles converted into yuan in Almaty. Euros turned into dirhams in Dubai. Indian refiners paid in rupees. Russian exporters stored value in gold, crypto, and off-ledger clearing systems. The financial rand of the 1980s found its digital reincarnation in stablecoins and peer-to-peer payment networks. Trade itself followed. European goods banned by regulation reappeared in Yerevan and Astana. Microchips labeled as household appliances crossed Central Asia. Parallel import corridors grew into formal industries. Armenia's imports from the EU tripled in 18 months. Kyrgyzstan became a logistics hub for German car parts. The map of Eurasia redrew itself, not by conquest, but by workaround. Some call this resilience. Others call it illusion. But the mechanism is undeniable. Sanctions disassemble the global market and force it to reassemble under new ownership. Every intermediary earns. Every detour becomes a revenue stream. In 1980, the brokers sat in Geneva. In 2024, they sit in Istanbul and Dubai. The language of profit is unchanged. Meanwhile, Russia's internal economy mutates. Scarcity drives domestic production. Import substitution, once a slogan, becomes necessity. Chinese and Turkish suppliers replace European ones. Local factories replicate Western designs with mixed success. The state calls it sovereignty. The market calls it survival. Yet the deeper transformation is cultural. Under pressure, a new business ethic emerges. Flexible, opportunistic, and post-legal. Contracts rely on networks, not courts. Trust replaces transparency. Those who master ambiguity thrive. Those who demand clarity fall behind. This is precisely how South Africa's underground economy once functioned. Pragmatic, adaptive, morally neutral. The irony is sharp. The very global order that built sanctions to enforce moral lines now depends on the same shadow logistics to keep its supply chains intact. Indian refiners buy discounted Russian crude, re-export refined fuel to Europe, and everyone pretends the molecules have forgotten their origin. The system doesn't break, it bends elegantly, and in that bending lies the insight. Sanctions are no longer punishment, they are reallocation of risk, profit, and power. When access closes, intermediaries rise. When compliance costs soar, informal economies bloom. The sanctioned state doesn't vanish, it decentralizes. It stops being a player and becomes a platform. Look at the data. Despite record restrictions, Russia's GDP contraction in 2022 reversed into modest growth by 2024. The ruble wobbled but didn't collapse. Exports flowed eastward. The architecture of global trade shifted from West-centric to multipolar, not through ideology, but through necessity. History didn't repeat, it evolved. Then it was apartheid and Cold War politics. Now it's sanctions and digital globalization. Then gold was the escape valve. Now it's crypto wallets, yuan clearing, and anonymous shipping registries. The mechanics differ, but the logic remains identical. When legitimacy becomes a barrier, innovation becomes subversion. Some historians of the future will call this the Great Rewiring, the moment when the world discovered that its financial nervous system could reroute itself overnight. And perhaps when the West learned that isolation in a networked age is a myth. The question then is not whether sanctions work, it's whether we understand what they actually build in their shadow. The story of sanctions is never about morality, it's about momentum. Each attempt to freeze a system only proves how fast it can move when rules dissolve. In the 1980s, tankers hid behind false names. In the 2020s, algorithms do the same. The disguise has changed, the instinct has not. Nations learn what corporations already know. Value always finds a route. South Africa's parallel markets ended when the walls of apartheid fell. Russia's will end when another wall shifts, political, technological, or generational. But the infrastructure built in the shadows rarely disappears. It lingers, patient, ready for the next crisis that demands improvisation over obedience. That's the hidden legacy of every embargo. It teaches the world how to trade without permission. And once that knowledge exists, it cannot be sanctioned away. Perhaps that's why history feels circular. Each era builds its walls higher, only to discover that the tunnels were already there. The real question isn't how to stop these parallel markets, it's whether we still believe the official ones ever truly existed.